Has anything changed about how you're thinking about that 60% bucket as an equity strategist? Last year we had that sort of glimmer of outperformance for value that a lot of people were waiting for. Not so much this year, but how are you thinking about that equity allocation right now?
Yeah, I mean, I think that one of the flaws of the 60-40, just thinking bigger picture, is that it doesn't have an inflation hedge, and it's very simplistic terms. It's just equities and bonds, but you can certainly be smarter about the allocation within the equity and bond universe. And certainly if your equity universe was all energy stocks last year, the 60-40 worked pretty well for you.
Yeah.
Right. So I do think you want to consider the inflation regime that you're in, as Urian mentioned. And we are at a critical turning point from my perspective, where bonds and the inflation charts by themselves are all signaling that we're probably breaking into a different kind of regime. And if you're stuck in a 60-40 that's just the S&P 500 and a Bloomberg Ag, or the S&P 500, or even a diversified world portfolio, and some version of world treasuries, you're still going to underperform without having a heavier inflation tilt or some versions of inflation hedge in there. And when we look at the longer term perspective, you are seeing some pretty strong performers break out longer term that would imply that we are in a different kind of inflation regime as it is. So most of our work is suggesting that from an allocation perspective, you want to lean out of long duration, growth sensitive segments of the world and toward shorter duration, value sensitive segments of the world as a longer term investor. That means if S&P 500 is your representative of that 60%, you're going to underperform.
I would just add to that you're exactly right. I mean, equities do provide some inflation hedge, but periods historically of higher inflation have produced a very definite value tilt over growth.
Mm-hmm.